Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today, specifically, we're going to be going through three charts that a would-be short put seller might want to first consider before planning and placing that trade. We're going to be using those charts to get a gauge of stock market conditions, options market conditions, and the individual stock itself. Should be a great discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names out there in YouTube. Hello there, Eva and Mark, Life in the Fast Lane, Josh, Kevin, Kelly, Lawrence, Jay Richardson, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy that presentation. But be aware that you're invited to join us in the live discussion. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time. We'd love to have you here in the live stream audience. And those that are here in that live stream already know that my very good friend Ben Watson is hanging out in the chats. He's going to be addressing any questions that I can't get to during the flow of the presentation. Ben and I have been working together now for more than 2 decades. Ben's just fresh back from another great workshop out there on the road, Ben. So welcome back. Great to have you here. Thanks for having my back there, Ben. And Ben and I would also like to issue an invitation to everybody watching. If you have an account on the platform known as X, you should be following your favorite presenters there. It's the very best place to connect with us. In between these live streams, you can find Ben there on X at Ben Watson CS. You can find me there at Cameron May CS. But let's get to this discussion of selling puts. But first, taking a look at what three charts that some traders consider to be essential for planning that short put trade. All right, but of course, as we do, we need to consider the risks associated with trading. Risks are real. We need to bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's go. Let's set an agenda for what we want to cover today. First of all, we need to be aware that this video is part of an ongoing webcast series about trading covered calls and short puts. So the first thing we're going to do is follow up on some existing or recently concluded trades in our example paper money portfolio. Then we're going to have a quick look at these three charts that I was referencing, and we're going to plan and place an example short put trade for income using those charts. That's what we're going to be doing today. So let's go right to the Thinkorswim desktop trading software platform. And at the moment, we have 5 current positions. Well, when we concluded things last week, we had 7. What happened to the other 2? So we have 2. We have Abbott and we have NVIDIA that have concluded. Let's quickly revisit those trades with ABT, Abbott Labs. This was a covered call. We initially took this trade right back here. You'll see this blue oval. We bought 100 shares at 128.68, and then we sold some calls through these time frames. This dashed line here, expiring here, this dashed line, and this dashed line. So this call expired. We made a 132 profit. This call expired. We made a 191 profit. Now, finally, we sold the 15th of August, which just passed. That was last Friday. The 130 call for 72 cents of additional premium. That contract was assigned. So we bought the shares for 128.68, ultimately sold them for 130. Small profit on the stock. Along the way, collected a few premiums for income. So our final profit there, 527. That's now a finished trade. All right. Now, our other trade that concluded this week was our NVIDIA short put. This one's pretty straightforward. We sold a 15th of August 170 put. You can see our put, the line here representing our strike at the 170 level. Our contract was well out of the money as we hit that Friday expiration. That one just expired worthless. Expired. We retained that 258 now as a realized paper money profit. All right, so those are our 2 trades that have just concluded. There are 5 current trades. So let's have a quick look at those, see if there's something that we need to do with some of these. As a matter of fact, there's one that I'm going to be adding to today. But Apple is a covered call. We own 100 shares. We've sold a 19th of September call That's not the whole story for Apple. So with Apple, we originally sold put way back here. Sold a put way back here, the 235 put. It was assigned. We collected a $3 premium from that put, but assigned at 235. Now, since then, we sold some calls, made an 80-cent profit here, a 149 profit there, 225 profit here, 165 profit there, 133 profit here. And we've now sold a 19th of September 225 call for 114. So the trader's preference here might be that the stock sags back down if they prefer not to get called out. But maybe we prefer for this to come back down to just below that 225 strike. That would allow us to retain the shares. Or if we get called out, we're actually still above our break even of 223.24. So this is a trade that was underwater for a few months. We were digging and digging and digging, see if we can get back on the right side of things. But as is commonly the case, it was really the movement of the stock that really helped us out the most. Yeah, F111 says so much important stuff going on with Apple. Yeah, this has finally pushed us back up above the break even. We'll let this one continue to work. It doesn't expire until September 19th. With NEE, we have 200 shares, and we're currently in a 19th of September $75 call. So here's our history with NEE. And as I go through these trade histories, if you want to see these trades as they've played out, well, in this webcast series, we record all of these and we post them to our YouTube channel. So if you haven't done this already, make sure that you have subscribed to our Trader Talks channel on YouTube. You can go down the lower right-hand corner and click on that subscribe button. It only takes a second, doesn't cost anything. But our YouTube channel, Trader Talks Schwab Coaching Webcast is the full name of the channel. That's where we house these webcasts once they've been delivered, house them under our playlists. So I can go to the playlists here. And this one, if we scroll pretty much to the bottom, then we just look up a few lines, you'll find it right here. Trading covered calls and short puts. There's the full playlist. And we can see when those previous trades were taken, when some of them have been extended, maybe through rolling or expirations, that sort of thing. That'll give you that history if you're interested in seeing those. I don't make any changes to positions when the camera's not on. So you'll be able to follow the whole logic of each trade. So with this one, we sold a $72.50 put right back here. That was ultimately assigned on the 18th of April. We did keep the 156 premium from that. Now, since then, the stock has been pretty much in recovery mode. So we've sold a call against that long stock position for $55 profit. We've sold into some current calls for 112. That's the current credit. Our break even is down here at 68.27. The stock is cooperating nicely. It has gone in the money, but still some time till expiration. So we'll see how this plays out. With this one, we're going to leave it alone. It's doing just fine. See, we have a profit there in addition to realized gains that we've had in the past on NEE. Our Tesla position was, I think, we need to do something with this. So here's what's going on with Tesla. Bought some shares. This has been quite cooperative for us. Bought the shares at 233.07. They're now worth 334. We're up just a modest $100 per share on our stock position. Along the way, we've sold some calls, collected a profit here, a profit here, a profit here, a profit here. But this most recent contract that expired on August 15th, you can see that we were below that strike price. That's expired worthless. So that's now a realized gain. Now with each of these, it's not including the commissions. So we'd have to subtract 65 cents from each, not 65 cents per share, just 65 cents for the contract. So this one, for example, $265 profit minus the 65 cents. So 264.35 would be the realized gain there. Anyway, so our break even's way down here. Our trader here might still, if they're technically oriented, maybe if the stock were to fall down, start to break below support levels, we might decide to exit. There could be other reasons. Mighty Mouse says, when you have a covered call on your stock already, do you still have the stop loss on stock? That's a possibility, Mighty Mouse, but we just have to include when we place that stop, if the trader doesn't want to, leave themselves to selling short, haven't, or actually, yeah, we just want to make sure that we include in that stop, include in that order to get out of the short option at the same time if the stock is triggered to sell. Right, and as always with the stop order, I just have to throw out the reminder that stops are not a guarantee of a specific exit price. But there we go with this one, though. Our stock is still, it appears to be behaving bullishly. Let's say that our trader here still thinks the stock is likely to run further. How about if we were to sell a new call? Let's go up here to this previous resistance. Is that about 365? Let's maybe sell a 365 call up there for that September 19th expiration. PL Anderson says, think it's illegal on shares to add a stop? Not necessarily. It depends on the structure of one's account. In a margin account, it wouldn't be illegal. In an IRA, it would be, unless we include instructions in that order to get out of the call obligation. In other words, close out that call contract first, and then stock shares. Good point. All right. But yeah, let's maybe sell that 365 if there. Let's go see what the credit might be. Let's go to the trade tab. Yeah, let's stick here with the 19th of September, go out to that 365 strike, and it looks like that's paying around 775 to 785, maybe about 2% on this, on the current price of the shares. So let's do that. Now remember, with Tesla, we only have 100 shares, so we want to make sure that we match that with a quantity of just one contract. Let's click on the bid price there. So we're selling up there. Some traders like to sell up at previous resistance levels. So if the stock does go up, maybe it'll just stay below that strike if the ultimate objective there is to retain ownership of the shares. Let's sell that 365 call. Let's say we're willing to accept just the natural at the moment, 770 as a credit. Even then, we might not fill this order. We're going to sell the 365 call, trying to get at least 770 as a credit. This is going to tell us there's an infinite maximum loss. There's not, because we own the shares. There is a commission to be paid, so that chips into that credit a bit. Let's send that order off. Benny says, I thought there is no assignment paper trading. Benny, there's not assignment before expiration on paper money. However, assignment is simulated at expiration. So, yep. So your paper money account will behave very much like a real account at expiration. Before that, though, unlike a real account, there is no early assignment. All right, so we've sold that Tesla short call. It's waiting down here in our unallocated area. Let's just move that. Right-click. Let's move that to our covered calls and short puts. So it's now paired up. There we have our covered call. So from here, we'll see how this goes, but we've sold right up here. If it's helpful for you, I like to draw in these lines just to show where our contracts lie. There's our 365-ish. You really want to see how I set this up. I'll just draw in a line roughly from where I started the trade until the expiration, and then I'll edit the properties that line. Right-click, edit the properties. My preference is to just make it as precise as possible. Let's make it start and finish at 365, and then we'll just make it red, just to indicate that we sold a contract right there. All right, so that's Tesla. That's the only one that we're going to be making any changes to today. We just have a couple more. We have our Visa position, which is another covered call where we've sold the 19th of September 360 strike. And you can see right now, the stock is at 341, so that's still out of the money. Here's the trade history with Visa. Sold a put. That one just expired. So that was a realized gain. Sold another put. That one was assigned at the 330 level. So 330 was the price we paid for the shares. Shares are now worth 341. So we're up on the shares. We also have realized profits on the 257 contract, or on the 257 premium collected here and here. Right now, though, we're just in this short call. That seems to be well out of the money. We'll let it continue to work toward expiration. However, we have a note to ourselves. If we start to break down. Now, this is something, I didn't change the trade, but I did put this note on here when the cameras were off. Just a note, let's have a plan to exit the whole position if this support breaks. Now, the trader could go in and put in a stop order. As a matter of fact, question came in, Can we have a stop? Yes, let's do it. How might we do that? If we have the plan to get out, well, here, looks like our support is there at 330. Let's say if it gets down to 328, a couple of bucks down below 330, maybe our trader wants to get out of the whole covered call position. Here's how that might be done. We go to our monitor tab, right click on our symbol, and create a closing order. So we're going to sell this covered call, but not right now. This is in order to sell the shares and to buy the contract back. So it doesn't leave us, maybe if we're in an IRA, in an illegal position. But when do we want that to happen? Well, we've decided this is what we want to do. We want to sell the covered call. Let's set that at a market order sometime in the future. But we want this to happen if the shares of Visa, which are right now again at 341, if the market value happens to fall down to less than or equal to, what do we say, 328 bucks? 328. So if you haven't used the order conditions page before, this is the condition, and this is what we want to have happen if the condition is met. So if the market value of Visa falls to less than or equal to 328 bucks, then we want this to happen. Sell out of this covered call at whatever the market price is for the contract and for the shares at that time, good till canceled. Okay. So notice as I click confirm and send, it's not telling me I'm doing anything that's not permitted. This is allowed. I will say it's not guaranteed that we don't know exactly what the shares will sell for. If we go down to 328, we don't know how much we might have to pay to buy out of that call contract. It's probably going to be less than what we sold it for. But in any case, we're going to sell this. If Visa falls at or below 328, there would be a 65-cent commission on the option to buy that back. And there are a couple of important reminders down here. Due to potentially wide markets or liquidity risks at the time of activation of the stop, this order may be manually substituted with a limit order upon activation and worked until filled. And with stop orders, there's no guarantee that the execution price will be equal to or near the activation price. All right, let's send that off. So there we go. That was, Rory says, why not get out at the value you were assigned the shares? Now, Rory, that's another thing that the trader might do. The difficulty there might be, that would be a plan to get out right when maybe the trader thinks the stock is possibly set to rise again. So if they see this as a support level, getting out right at that moment may to some be just the wrong moment to get out. It might result in getting out at the bottom. But of course, the stock could continue to fall. It's a good question, though. All right. The logic of our exit there is getting out just below this support, which does happen to coincide with the price we paid for the shares. Would have us selling the shares at a little bit of a loss. Does that mean the trade would be a loser? Not necessarily, because we've collected premiums along the way that would probably more than make up for that. Our break even, remember, is down here at 323.44. In any case, there we go. Done with Visa. Really interesting thing happened with our Walmart trade. This was a covered call. Right now it's just a long stock position, but we had sold the $100 level strike price for the August 15th expiration. Let's look at this. I want to show you what happened with Walmart. Really, really interesting. All right, so this one we actually sold a put way back here. Sold that for 162. We were assigned the shares at $95. Stock has been up and down since then. That one had kind of just fallen by the wayside. We were ignoring it in the unallocated area of our paper money. I brought it back into the discussion, and we sold a call against that. Sold the 15th of August $100 call. So had we been assigned, we would have wound up selling shares for a $5 profit. We collected a premium here for 84 cents. That one expired. But look at this. So if we sell a call for $100, someone has the right to buy shares from us for $100 per share. Look at where we expired on Friday close of business. If I put my cursor right on Friday's candle and you look up there at the C for closed at $100, not 99.99, not $100.01. It closed on the money. And this brings up a good question. What happens when a strike, it's a rare thing, but it does happen. What happens when a contract expires precisely at the money? Well, at that point, the Options Clearing Corporation sees that as having zero value, which is what is the case, and it's not typically assigned. Now, someone else could leave assignment instructions. They could assign the contract anyway. That's still a possibility. But this was not in the money. It was at the money on the nose. 4 o'clock Eastern time is the settlement price that the OCC uses, not assigned. Well, it was looking like we were going to get assigned, didn't. So we kept the shares. What do we do with those shares now? Well, there's an earnings announcement. I'm not going to sell into a new call with that earnings announcement looming. For some traders that prefer not to hold a covered call over earnings. Not everybody, but that's the way we're going to manage this one. So that was interesting. We're still well above our break-even point. Let's see. What was the question? F111. Sell position affect the outcome. I think I'm going to need some clarification. Looks like Ben's digging into that. Thank you, Ben. Anyway, that's it for our current positions. That was quite a bit to cover. But let's now look at 3 charts as we plan and place a new short put for income trade. What are 3 charts that a trader might want to check first before doing that trade? Well, first, selling puts for income is actually a bullish strategy. And so maybe the trader might want to gauge just general market apparent sentiment by looking at a major market index. So in this webcast series, we'll use the S&P 500. Not everybody uses the S&P as their gauge for which way the stock market's generally headed. But let's just say that our trader looks at what's going on with the S&P, and we're just on Friday, once again, setting record highs. We're not at a record high today, down a fraction of a percentage point. But let's say that our trader is planning to sell a put now again for that. Let's go for that September 19th expiration again. If you're wondering why I'm doing September 19th and not some weekly before then, the monthly contracts tend to have a little bit better liquidity. So for that purpose, I'll tend to stick with those, but not every trader does it that way. But our trader here just might want to gauge for themselves, do we think that stocks are likely to continue to rise between now and September 19th, or we think there's going to be a major reversal, in which case maybe they want to pump the brakes on a new bullish trade, like a short put for income trade. And let's just say that maybe our trader thinks, okay, maybe we drift down a little bit, but by that September expiration, maybe we just continue going higher. That might be their general outlook. Now that might play out, it might not, but that may be chart number 1. Take a peek at what's going on with the major market index and just gauge whether a bullish trade seems to be a good idea at the moment. Now, next, that's what's happening with the stock market. Well, we're not trading stocks right now. We are trading stock obligations, but maybe the trader wants to also look at what's going on with the options market. Hey, for you income traders, let me know. How are the premiums out there right now? How do premiums seem to be relative to other times in market history? This is an important question, and a potential answer might be accomplished by looking at a chart of the volatility index of the S&P 500, otherwise known as the VIX. So this is a chart of generally, basically it's traders' expectations of volatility on the S&P 500 for the next 30 days. Sometimes there's an expectation of strong volatility. Sometimes there's an expectation of low volatility. This is determined by using the pricing of options. And therefore, there is a strong relationship between the general pricing of options and the movements of this chart. And so for some traders, they look at this when there's a spike up on this chart, they would generally say premiums pretty high. For the most part, across most strike prices on most stocks, pretty high premiums because of that volatility, because of the correlation between options pricing and volatility levels. When volatility is high or is expected to be high, there tends to be strong demand for options from speculators and from hedgers, and that drives prices up. When the expectation for volatility is comparatively low, there tends to be more modest demand for options from speculators and from hedgers, and the options prices will tend to be low. The premiums will be small, for better or for worse. But for some, they'll say that when volatility is low, they might generally describe that as a buyer's market. When volatility is high, they might generally describe that as a seller's market. Well, guess what? We're selling options in this webcast series. We don't buy any options. It's covered calls and short puts, both are selling. So what I want the trader to know here is that they just need to be emotionally prepared for how things currently are and how they may play out from here for this trade that we're planning. First of all, with volatility low and premiums probably also low, our would-be short put seller should be prepared for the fact that maybe the premiums this month aren't as good as what they've gotten in previous months. There's a reason for that, because traders might see smoother sailing for the next month. So that there are pros and cons to that. We just need to know that we're probably not going to see as quote unquote juicy premiums as we go looking right now. Now, another thing is, if volatility starts to rise, that can tend to prop up the pricing of options. Volatility rises, options prices tend to go up. So if we just sold some options, we're waiting for the price to go down, that can slow that process down. That's just sort of how things appear right now. But this is a second chart that a trader might want to check before planning and placing a short put trade. So I'm going to be still going ahead with the trade, but for some, it might be enough that they might go look at their stocks that they intend to sell puts on, and maybe they just don't like the premiums they're seeing, and they might decide to wait. All right, but a third chart that the trader might check, we've looked at the stock market chart, we've looked at the options market chart. Well, now we might look at the stock itself. So let's use an example chart to explore what a trader might be looking at as they're looking at an example chart for the individual stock on which they're going to be selling the put. I have a couple of examples, and then I want your input. You help me choose which one of these we're going to sell a put on. So here's our first one. So as we look at ExxonMobil, here's what our trader might want to have in mind as they're planning this bullish income strategy. First, they might want to determine whether they actually think the stock is likely to behave bullishly between now and the expiration for their contract. So what do you think? With ExxonMobil, some of you might notice, hey, isn't there a lower high and a lower low right there in the last 6 or 8 or 10? It's probably longer than that. Let's call it 10 or 12 weeks. I think that case could be made. But where has that short-term trend taken us? It's taken us down to maybe an intermediate uptrend. And for some, they might see that as just where they like to be when entering into a bullish trade that expires in a shorter period of time. So let's say that our trader's outlook here is that they think we've come down to support, and maybe ExxonMobil is likely to reverse upward. Now, with short puts, depending on the strike prices selected, there can be some wiggle room there if our timing happens to be off. It also says, I'd say, slightly bullish. Okay. All right, well, let's just keep that one in the back of our minds. That's one. That's our ExxonMobil example. Let's also look at maybe T-Mobile. Wes, here's a stock that was going down, but more recently, it's for those that prefer to see higher highs and higher lows. This one seems to be doing that. And it looks like it might have just pushed through a recent price ceiling, maybe at around that just above 250, 252 level, pushing through, continuing with white candles. And even for those that look for what we call bull flags, maybe there's a pretty good flagpole right here over the last, this is about 2 weeks ago, ran up, pulled back, starting potentially to advance again. So maybe our trader here sees potential for momentum to continue in that direction. So in any case, the take-home message here is if a trader uses charts in the planning of their trading, not every trader does, maybe they might be looking for indications of bullishness for this bullish strategy. So with that said, Which one? What do you think? XOM, which is actually more recently it's been coming down, but possibly at a support level, or T-Mobile, which is more recently going up, a little bit of a pullback over the last, it's called 96 hours, pulling down, starting to bounce again. Kevin says TMUS. There's one vote for TMUS. Giveaway says XOM. Got a second, third vote for TMUS. Okay, 3 votes. That's going to carry it. Let's do T-Mobile. So check the stock market. We checked the options market. Now we've looked at the chart through at least one technical lens for the individual stock. So now let's talk about strike selection. Well, for some traders, if the objective is for the contract to expire worthless, if they're very confident the stock is likely to go up, they could get a little bit more aggressive and sell an in-the-money contract. That's going to be a lower probability, higher reward scenario. But with this one, how about we go for the higher probability scenario and settle for a smaller reward? Let's look at selling out of the money, maybe selling a put down below our breakout point. What if we sell this 250 put right there? That's going to be down below support. So even if price comes down, maybe our trader thinks, it shouldn't go below that support. Maybe it'll rebound off from there. What can we get for that 250 put? Let's look at our 19th of September. Look at 250, which is going to be right up here. For those who use deltas as a guide, there's about a 33% probability of this one expiring in the money. That's one of the potential uses of delta. If you're not familiar with delta, a couple of ways that traders might use this Greek is, number one, it can show how much an option is likely to increase or decrease in value on a $1 move in the stock. So up or down 33, 32 cents. It can also tell us the approximate probability that a contract expires in the money. In this case, there's only a 32% chance. It was 33, just moved to 32. Only a 32% chance that this expires in the money. About a 68% probability that our contract expires out of the money. So let's maybe sell that 250. So we have chart logic for the trade. We also have a mathematical expectation for the trade. Let's place this trade, 250. To place that order, we're just going to click on the bid price. That creates an order. On my platform, it creates an order to sell one contract. It's because I changed the defaults to just do one. If it says 10 on your paper money, we just want to make sure that the trader is customizing this to the amount of shares that they're comfortable potentially trading, because we have to remember the obligation that comes along with selling puts. If we sell this contract for that 250 put, we're getting into a contract through the 19th of September where someone has the right to sell shares to us for $250 per share. Now, with the shares being worth more than that, there's little incentive for that other trader, the other party in this transaction, to assign that right. They still could, though. We just have to be comfortable. Someone could, at any time, sell us shares for $250. So if we did 10 contracts, someone could sell us not 100 shares. They could sell us 1,000 shares at $250 per share. That'd be a $250,000 potential obligation, right? How about for this one? Let's just do the one contract, selling that 250 put. Looks like still trading. It's the natural is 340, the mid is 350. I'm just going to leave that at 340. Say that we're willing to accept a payment of 340. That's going to be our limit. Let's click confirm and send. Going to sell this put at 250. But as we do, let's consider what might the trader do if the stock starts to break down unexpectedly. Mark says, how about we set up a conditional exit if the value remaining is just 20% of what we purchased them at? Could do. Now, we wouldn't say purchased, right? You know, Mark, I think you're typing that out. You meant what we sold or we collected for it, right? So if we're collecting 340, 68 cents would be the 20% of that. If we could exit for 68 cents, maybe we have a plan for that. That's if the trade is going well. Mark, we could. I'm not going to do that. Let's just sort of plan for the ugly side of the trade right now. What if the stock starts to fall? Well, we saw earlier how we can have an exit based on the value of the stock price falling. We can do that with a put as well. Let's say that our trader is still bullish if the stock is behaving bullishly, if it keeps going up. If it starts to come down, though, I don't want to be in this trade any longer. Now, how much wiggle room might the trader want to provide here? The more wiggle room they can provide, the stronger the likelihood that we don't just get whipped out of the trade. But of course, the more wiggle room we provide, the more risk we're taking on conceptually before we hit our trigger price. So there are pros and cons here. Could we just put in an exit right there at 250? Could. Wouldn't take very many days going the wrong direction to get us right back out. Could the trader say, well, if we get down below maybe this next level of support? Looks like there's another one right through there. Could we give it a little bit more wiggle room? What would that be? That looks like that's around 247. Maybe let it go down to 245. These are decisions the trader would need to make if they're placing this sort of an order. How about we do that? Let's say for this trade, we're going to let it wiggle around. If it happens to come down here, kind of spook us a little bit, as long as it reverses and goes back up, we want to give it that chance. If it goes much further than that, though, maybe our trend is in question and the trader might not want to be in that position anymore. Whatever their premise, here's how we might execute that premise. Let's go to our trade tab again. And instead of just doing the single order to get in, I'm going to do a first trigger sequential order to get in and also to get us back out if this trade starts to falter. So once we've selected that, we can right click and create an opposite order. The plan here was to get out if we fall down to 345. So let's use our gear over here to add a condition. We're going to buy at the market price, whatever it might happen to be, if we fall down to 345. Let's just put in that condition. If T-Mobile market value falls to less than or equal to, was it 245? I always just sort of click up here, drag down. Yeah, 245. So there's our condition. Market value of T-Mobile falls below 245. We're going to buy that put back at whatever its market value is at that point. Is it going to be more than what we received originally? Yeah, it would be. I can't imagine a scenario where it wouldn't be if we fall down there, unless the stock were to go bing and just take off and go right back up and we happen to get out at a more favorable price. Anyway, let me just save that order. That is going to be our trade. Let's click confirm and send. Selling to collect a 340 premium here. We're going to buy out of that if we slip down below 245 or whatever the cost is at that point. But at least that is just designed to help stop the bleeding. It would be a losing trade. We're just trying to prevent it from losing more at that point. And due to potentially wide markets or liquidity risks at the time of activation of that stop, that order may be manually substituted with a limit order upon activation and worked until filled. So there are commissions to get into this trade. There would be a commission if our stop gets triggered to get back out of it. Let's send that order off. And we're done. We sold that for 360 credit. So from here, boy, I got a cluttered chart. Here's what we'd like to have happen. Let me just clear up some drawings here. I'm going to be precise about which drawings we're clearing out. There we go. In any case, this is the put that we sold. Let's make that one 250. This is a nice little visual reference point. There's our obligation from here through September 19th. Someone has the right to sell us shares for 250. If the stock keeps going up, it's just unlikely they will decide to assign that contract. They still could. Even now, the money contract could be assigned. But most likely, if we keep going higher, the contract just expires worthless and we keep our 360 that we've collected. If it falls, it could even go down below our strike. If it drops down here to about what do we say? We did 245. That's down here. That's how much wiggle room we have. Let me get rid of this line. Don't even really need this one anymore. There's our strike. There's our contingent stop order. All right, everybody. Hope you've enjoyed this discussion. We've accomplished what I set out to do today. I wanted to talk through 3 charts that an income trader might want to first consider when they're planning and placing a short put order. That is, first of all, look at a major market index. The one that we used as an example today was the S&P 500. Secondly, maybe we want to gauge what's going on in the options market. We looked at the volatility index of the S&P 500, which can give us a general gauge of whether premiums are comparatively high or low on most stocks. Mark says that's an impressively juicy credit considering how low the volatility index is. So is it possible that even in a low volatility market environment, our trader might still be okay with the available credits? Yeah, could be. Now, that's not a guarantee that we're going to succeed with this trade. Time will tell with that one. But we planned and placed that trade. We've accomplished everything that I wanted to. Time for me to let you go enjoy the rest of the webcast for the rest of the day. But as you go, remember that you have some resources outside of these live streams. Number one is if you haven't subscribed to our Trader Talks channel, please do that now. You can go down the lower right-hand corner, click on the subscribe button. Only takes a second, doesn't cost anything, but our Trader Talks channel, full name, Trader Talks Schwab Coaching Webcast, is where we house previous webcasts for these series. You can join our live streams, of course, but you can also do keyword searches to scan through all of our existing webcast archives. Also, if you have an account on X, if you have an account on that platform, you should be following your favorite presenters there as well. You can follow Ben on X at Ben Watson CS. You can follow me on X at Cameron May CS. And this is where we can, let me bring up CS so you can just see what this looks like. There's my handle at Cameron May CS. But this is where we can post maybe more timely things when the camera's not on. We don't have to wait around till the next live stream kicks off to just let you know things like, hey, everybody, here's a quick demonstration of how to set up custom arrangements of stock charts on Thinkorswim. So I made a little 2-minute video that demonstrates how that's done. And I can post that on X. And then if you reply to one of my posts, I just try to reply right back to you. I was on here earlier today replying to some of the comments on this and some of the comments on previous posts. Really is the best place to connect with Ben and with me in between the live streams. All right, but Ben, hey, thanks for helping out in chat. That's definitely appreciated. And everybody, thank you to all of you who have already clicked that thumbs up button. If you enjoy one of our webcasts, I hope you have a habit of just clicking that like button. It definitely helps. It's like applause to your presenter. And it gives a boost to the webcast or the video for the webcast and YouTube algorithm so more people find this stuff. But I can see 139 people watching live right now. 46 have already clicked that thumbs up. Thanks for doing that. Definitely appreciate it. All right, everybody, go enjoy the rest of your day. I will see you maybe in tomorrow's webcast. I have something new every day of the week, so you're certainly invited to join me in my other live streams. I'll certainly look for you next Monday to follow up on this trade and on the rest of our example positions. But I'll also look for you on X. But hey, whenever I see you again, until that moment arrives, I do want to wish you the very best of luck. Happy trading. Bye-bye.